Let's discuss the factors at play ahead with Pramod Gubbi joining us from Marcellus. Pramod, afternoon. Thanks for your time. Pramod, what are your thoughts on the way Indian market valuation, the broader, the larger market, the larger cap companies, the bigger company universe is trading at right now, compared to, how the flows, the earning quality, and the valuations they are trading at right now?
Thank you. Thanks for having me here. Yeah, I mean it's been a difficult year for the markets, not just because it's up or down, but it's actually up and down. So I think the factors explain the volatility in the movement of the indices as well. So first of all, the macro factors themselves have been a little unpredictable. We began the year, just getting off the Omicron wave and things opening up, only to see the war situation come in and creating a rally in commodity prices and global inflation, which in turn resulted in interest rate hikes, which have created a dampening effect on the markets. Having said that, some of these factors are unwinding. Clearly, the rate hikes have had their effect in terms of dampening demand, which is the intended effect, which in turn has curtailed some of the commodity price inflation. Some aspects of the supply side constraints on commodities have also sort of abated. To that extent, we are seeing inflation coming off, and that's what's triggered the remarks by the Federal Reserve Chairman last night. Having said that, I don't think we're totally out. We still haven't seen China completely open up. That will have its own reversal in terms of demand for commodities and commodity prices. So I don't think we can expect a straight line journey from here on as far as inflation and interest rates are concerned. To that extent, implications on the Indian markets, I don't think valuation is so much of a concern. Maybe on an absolute basis, yes, but relative to other emerging markets, clearly India stands out, both in terms of the quality of the companies in the index, clearly demonstrated by the higher return on capital compared to most other emerging markets or the emerging market index that way. But also the stage of the economic cycle we are in. We are seeing a lot of boxes ticked for the macro situation for India, be it the strength of the banking system, stage of the credit cycle, the leveraged or the lack of leverage in Indian corporates, which is looking good, and also from a utilization level where private capex is beginning to take off. From the government's balance sheet perspective, I think tax buoyancy is also pretty healthy. Of course, the fiscal deficit needs to get corrected post the pickup in the COVID stimulus tenure. There again, the commodity prices will play a big role. If we see sustained deflation coming through, the government is in a good spot in terms of bringing fiscal back to its shape. So to that extent, I think both the stage of the economic cycle should augur well for earnings, but also any sort of deflation we see in commodities should be a relief, because what we saw in the most recent quarter was top line growth is pretty strong, partly helped by the nominal number on the revenue, but margins have compressed because of the higher commodity prices. That should sort of soften as we go ahead. The December quarter results should show some sort of margin expansion. To that extent, earnings growth should come back in. So net, I think we are in a relatively positive situation, despite the fact that markets are at all-time highs. Markets are meant to be at all-time highs most of the times because this is a growth asset class. As earnings keep growing, the value of the indices will also be high. So for a longer term investor with at least a 3-year horizon plus, I reckon this is as good a time to invest in the Indian market.
Clearly it is. Pramod, out of the portfolio companies in your portfolio, which were the ones which saw the maximum hit, or what are the baskets which saw the maximum hit on margins? And what is the commentary coming now? Do you see worst of margin pressure behind them? What are the management commentary indicating, or in the coming quarters?
Yeah, so I mean, like I said, commodity prices have been volatile. It's very difficult to forecast from a quarter-on-quarter perspective, but at least based on our conversations, we reckon a whole host of commodities have actually corrected quite sharply. Remember, there is always a lagged effect in terms of the company's numbers, because there is a purchasing cycle involved. So the sort of numbers you'll see in the cost of goods sold for this quarter would be based on the raw materials purchased a quarter ago, or in some cases perhaps 2 quarters ago. But adjusting for that lagged effect, most companies are seeing a significant deflation in their raw material prices, and therefore, starting with the December quarter, we should see margins expanding. There's no a specific company. Like I said, there are different companies with different extents of pricing power. Their ability to pass on price increases to their customers is different from the others. Different working capital cycles. Some may have to buy raw materials 3-4 quarters ahead, or some have a lot more flexibility on that front. So depending on that, the actual impact could vary in terms of timing. But I think if you were to draw a pattern, clearly we are seeing a softening of commodity prices, and that should suggest a boost to margins in the next couple of quarters.
Pramod, what are your thoughts on the commentary seem to be suggesting from the government side yesterday, front page Economic Times, that the government will be trying and moving in the direction of growth and not populism. They would be, as far as the budget is concerned, though the bulk of the policy moves are now happening outside of budget, but still this kind of messaging to the market, because there was a fear of some sort that probably budget would be tilted more toward populism. Would that be a right thing to do, given the environment and circumstances, to keep on continuing to press the pedal on growth front?
Yeah, I think the messaging has been clear from day one since this government took over. Of course, it did take time to fix the fiscal deficit in the balance sheet, but I think the most important development has been the build out of the direct benefit transfer plan, which creates significant efficiencies on the welfare front. I don't think any government, including this one, would want to ignore that. There are genuine social issues around income inequalities. Development, albeit, will have a trickle-down effect, will not be uniform across all geographies, all economic strata. To that extent, some element of welfare will always remain part of the government agenda. But the biggest takeaway over the last several years has been the efficiencies in the welfare program brought in through direct benefit transfers. That will continue. I don't think that's going to go away. That shouldn't go away either. But I won't be surprised with the focus on growth, because we're clearly seeing the benefits of that coming through. I think alongside DBT, one shouldn't ignore the benefits of GST, which has also increased significantly the tax compliance. Tax to GDP ratio at its all-time high. We reckon those two effects will manage, or will rather help the government to achieve the twin objectives of pushing for growth, at the same time looking after the sections of society which requires government's attention through welfare schemes. So I don't think it's an either or. It's a fairly well balanced approach by this government, and we expect the same to continue through this budget as well as in the coming years.
Pramod, is there any part of the market which, due to whatever reasons, has got very beaten down, even if it is for people questioning the business model and big outflows coming in, where you may see a contra opportunity emerging at the right levels? Would consumer tech companies interest you, or any of those places? Are you looking for ideas or revisiting the business model versus valuation argument?
Well, I think one of the moves has been the rotation away from quality and growth into value, given that the market generally perceives long-dated assets like quality and growth stocks tend to have long-dated cash flows, and therefore a hike in interest rates means that the valuation tends to get derated, because you start discounting those longer-dated cash flows at higher rates. So clearly quality has sort of underperformed over the last 12 months or so. We reckon as we see stability in the interest rate hikes, you might see quality come back into play, because these are genuinely long-term compounders. Many of them from a relative valuation perspective, given that they haven't performed, whereas several other parts of the market have performed pretty strongly, are looking really attractive from a relative valuation standpoint as opposed to their historical averages. So I would look at some of these pockets which historically have been perceivably richly valued, but have underperformed over the last year or so, coming back into the favor of the market as we got more color on interest rate stability globally.
Pramod, specifically, are you also analyzing Nykaa right now at current levels?
Well, not really. I mean, we did take a look of all the new age IPOs that we saw. I thought that that was one sort of met some of our screens, particularly in terms of capital efficiency compared to most other startups, which have been very capital hungry. They've taken a lot of money to build out the businesses. Nykaa has been an exception. It's been built on very little capital injection. That's the sort of business that we would like. But however, it's a young business. It's barely been around for a decade or so. We'd like to get more conviction in terms of sustainable competitive advantages, which in turn can underpin what seems like a rich valuation, but we might be wrong. But we will continue to do our work to see if our assessment of sustainable competitive advantages will give us the conviction that cash flows or free cash flows for Nykaa will grow at a healthy rate for as long as the next 10, 20 years to justify the current valuations. But at this stage, I think it's just on our watch list.
All right, Pramod, great chatting. Thanks very much for your inputs today.